Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Courser. Ron Courser and Associates are planning today for the potential of tomorrow.
And welcome into the program, ladies and gentlemen. This is your Course to Retirement with Grand Rapids resource for a common sense approach to planning for your financial and retirement future. He is Certified Financial Planner, CFP, founder, president of Ron Courser and Associates. Ron Courser with us. Ron, welcome back in.
Good morning to you, Peter, and good morning to everybody listening to today's program. We've got an interesting program today. We're going to talk about 7 financial myths. And in parentheses, you could put common planning mistakes and misconceptions. But the way I want to frame it is these are 7 myths, and as long as you don't buy into them, they're not going to be a planning mistake. So we're going to kind of approach it that way. Some of it is what I call everybody seems to know. And I joke sometimes that it's all the folks that meet every Monday morning at 7 o'clock down at Marge's Donut Den here in Grand Rapids that figures out what is the right thing, it's what they say is the good thing, they say. Those are the people down there. So if you want to be part of what they say, see if you can get in on that Monday morning, 7 o'clock donut rally down there. But we're just going to deal with this in a very objective way. If anybody has any questions or wants to talk to us, give us a call at 616-301-2594, 616-301-2594. Be more than happy to answer your questions, see in what way we could be of help to you. There really isn't any obligation to you. You know, we've gone through some interesting times here in these last 5 months or so. It's gone from, oh my goodness, to okay, maybe it's going to be all right, to, oh my goodness, to, I don't know what's going on next. And a lot of times what that does is that creates a sense that I don't know what to do that's right, so I'm not going to do anything. That may be a good approach and it may not be a good approach. But what I tell folks is that it's not a bad idea at all, because we do this with our clients. We're still talking to them. We're still doing reviews with them. We're still saying, this is what's going on. This is where your accounts are. This is what's happened. Are there things we can do from your point of view to make it better? Because this is what we call retirement your way. And so even those of you listening today who aren't part of our client base, we'd love to be able to talk to you about it. This is a great time to do a review. This is a great time to ask questions, the what ifs. What if this thing keeps going up and down crazy? What happens to my life savings? What if they fix this COVID-19 thing? What happens to the market, my savings? What if I get sick? I'm not talking about getting COVID-19, but is your portfolio, has it been created in a way that says we've handled that part if you get a catastrophic illness happen in your life? So even though it's a bit maybe unconcerned, a little bit, maybe a little confusing, now is a great time to do a review because we've been through some really bad stuff and we've had a nice bounce back in the market. But we all know that the economy and the stock market are 2 different things. While the stock market keeps wanting to go up because of all the government spending, we keep reading headlines and news bulletins that companies are shutting down, people are losing their jobs still. So it's a giant disconnect. And sometimes in that people, and it's a human trait. I mean, every once in a while I get it too. Well, I don't know exactly what to do, so I'm just going to stay where I am. That may be a good idea, but wouldn't it be better to be able to say, I'm going to stay where I am after you've had somebody take a second look at where you are, so that there's nothing going to surprise you. There's nothing that's going to jump out of the closet or come out from under the bed and scare you. So give us a call, 616-301-2581. Be more than happy to chat with you, either me or my partner, Nolan Gosley.
Again, 616-301-2594, 616-301-2581. The office number is 616-301-2594. The radio hotline will get you right through, and you can ask your question, or you can leave a message for the team and the staff there at Ron Courser and Associates. Again, Grand Rapids resource for a common sense approach to planning, a certified financial planner offering his time, his perspective, his guidance to your planning on a no cost, complimentary, no obligation basis. There's really no downside for placing that call. Never any benefit for procrastinating. So let's get that plan in place. Let's double check and review things. 616-301-2594, 616-301-2594. Ron, I've heard a saying. It says, when you speak of the disconnect between the market and the economy, I think people are waiting for them to come in alignment. But the saying that I have heard is that the market can remain irrational much longer than you can remain solvent. So it just seems like if we wait around for something to change in the market to actually reflect the reality of where we are, we might miss some opportunities for either protection of what's important or opportunities for growth on what we can't afford to risk.
Yeah, that's a great point. That really is. The markets are, I always look at them and say, I think let's just assume that they're always irrational. Particularly now, if you think about it, the market's gone up dramatically since the end of March, but we know the economy hasn't been that strong, although employment numbers are getting a little better, but there's still a giant disconnect. But what that does is it gives us an opportunity now for those of us who were in the market February, March, and April. It gives us an opportunity to sit back and say, what happened? Is there something I can do now in case something like that happens again? Is there, more importantly, are there some things I can take advantage of? You know, it doesn't matter what kind of market we're in, there's always some opportunity to take advantage of it. And sometimes a review can do that. It says, look, here's a way to take advantage of what's going on. It may not give you a 50% return, but it'll put you in positive territory and keep you afloat. So that's what we try to do to help folks. Is take a look at everything that's going on. How does it line up with what kind of portfolio or investment strategy they have? And are there ways to make it better, taking advantage of things or trying to avoid certain things?
Well, Ron, you've talked about that our results, the outcome of the plan is so often based on the assumptions that we include in our plan. And are they assumptions or are they certainties? Can we rely on this actually occurring dependably, or is this just something that we are assuming that is speculation that has some probability of success but some probability of failure? And I think that that is where these 7 financial myths, and if we rely on them, what could be mistakes or misconceptions at the very least, come into play. Is that all of these are assumptions that we carefully need to examine in our planning to see if we are acting as though they are certainties, as though they are dependable. And if we find that we are relying on them, how confident do we feel in that assumption holding true and being the case? So again, Ron Courser has this list. It's part of his series of the Countdown to Retirement lists of reports, but the 7 financial myths is what we will be reviewing today. And Ron, I think number 1 on that list is something that we have absolutely seen we cannot rely on dependably to absolutely be true, but yet it's still an axiom of the financial world. We hear the markets always go up. The markets always go up. That is anything but reliable.
No, but on a long enough timeline, there may be some truth to that. What do I mean by that? The markets always do go up over time. It depends on how long you're willing to wait and what kind of pain you're willing to endure. So let me explain a little more. Over the last 110 years, the markets have averaged an annualized rate of return of 7.1%. That's pretty significant because what it says is that, look, if you just put your money in the market and stay the course, over time, you're going to experience at least a 7% rate of return, sometimes a little more, sometimes a little less. There's 2 problems with that approach. Number 1, I don't know anybody that's been in retirement for 110 years. And number 2, and we've talked a lot about it, you know, the biggest risk in a retirement plan is that you take a loss the first 3, 4, 5 years right before, right after retirement. We call that sequence risk. So the markets do always go up, but they don't always go up this year or next year or the year after. And the problem comes in here. Now, if you have a life savings bucket of money and you never have to take $1 out of that to survive because you've got a great pension, you got Social Security, you don't have any debt, you're perfectly healthy. I know one client I have, they actually get two pensions, one from the military because they did 20 years and another from a major corporation. They have never had to touch their life savings. It's just one big investment portfolio for them. But that is really a rare situation. Most of us, I know not you, Peter, because you have that $10 million that we keep going back.
You love my
I do. Yeah.
my $10 million, but I'm spending it so fast, Ron. I'm still worried.
I know that. I'm gonna have to talk with your wife. Calm me down. Take away your credit cards. The problem becomes is that most of us need to take some money, income out of our retirement plan. And so if we assume that the market's going to go up 7%, that's not necessarily true, because let's go back and just look at recent history. Let's don't go back to look at the last 110 years. To the year 2000 through 2012. Boy, what in a world that was. We had two major corrections. We had two major, while the market went through the roof. But overall, that's called in our industry, we refer to that time as the lost decade. What do we mean by that? The market didn't make any progress. Basically, from the 1st of January 2000, and all that went on, it didn't come back to where it was for 12 years. So people who retired, let's say in 1999, when the markets were just exploding up, I've met some of them. They made assumptions that there would always be a 10 to 15% rate of return in their portfolio, meaning life is going to be good. You're never going to have to worry about anything. And then they got caught in that 2000, 2002 experience. It came back. 2008 was not a pleasant experience. But over that time, if you were betting your retirement income plan on the market going up every year, it didn't work. For 12 years, it didn't work. So what does that tell us? It tells us that the assumptions we make have to be really specific and really have a touch of reality to them. That's why when we talk about market averages and things like that and how much we can assume with the markets, it's always important to start off in retirement planning with the basic building block. And I know I go over it every time. I know some people are getting tired of hearing it, but I think it's that important. What is that? The basic building block in retirement is creating an income plan in retirement, where all sources, pension, Social Security, money coming out of your market-based investments, IRAs, things like that, annuities, you create an income plan first. Why? For this reason, when you create an income plan, if you have all the money you need to live on from your pensions and Social Security, it really doesn't matter long-term, then does it, what happens to the market? Yes, you can afford to take a little bigger chance. If the market rolls over on you, you have, time, you don't need to take money out of it. Hopefully it'll come back. But the real key is that, let's say you need $5,000 a month and your guaranteed sources are $3,000. Well, you have an income gap, okay? So we need to take $2,000 a month or $20,000 a year after $24,000 a year after tax. Always remember that's after tax. We need that from your life savings. So if we could get that $24,000 a year after tax, if you had a rate of return that was 3.75%, and that would give you what you need, and it would keep you up with inflation a little bit. Why would you want to create a strategy for investing your money with the potential of 10%, but the downside of, say, 15? Because the more upside you want, the more downside you expose your life savings to. That's why the income plan kind of puts up guardrails for you and says, what's the least amount of risk I have to take to get what I want, to get the income I want, the peace of mind that I want, to hold on to my lifestyle and retirement? What's the least amount of risk? Not the most amount of risk. I mean, anybody can take more risk. The real magic comes when you say, I can take the least amount of risk and get what I want and have some peace of mind and not be worried so much about what's going to go on around me.
I think that's a great point, Ron, that we have been told, and it's almost ingrained. The more risk you take, the better your returns will be. But that is not a certainty. That is not a guaranteed. And anybody can take more risk. I'm going to be as risky as possible with my money. That does not necessarily equate to higher rates of return over time. And if we are basing this on our retirement, or basing our retirement upon this premise, certainly, Ron, down years and early on in retirement are especially risky for our retirement outlook. They can really jeopardize our retirement. Any market professional, any financial pro is going to tell you that you cannot accurately time the market 100% of the time. They typically don't even try. But if all of our assets are in the market, it's almost like we're trying to base our retirement upon the market and just luck into timing our retirement correctly.
Yeah, it is. And sometimes it works. You know, you can take a look at the period, say, from 1993 to 1997, 98, 99. That was an incredible market period, just incredible. The timing between 2004, 5, 6, and 7 was pretty good too. But then we have those ugly periods that seem to take away everything we've gained. So the really critical issue is, what's the least amount of risk? How do I know that? You know, you can go to the casino, and sometimes I joke because people tell me, well, I go to the casino on Thursdays because the hamburgers are really great and the food's half price. And I say, well, bless you. But you know as well as I do that if you stay in a casino long enough, it is not going to end well. Now, if you stay in the market long enough and you're taking money out of your account without an established income plan, the potential for having a long-term bad experience increases, because the market giveth and the market taketh away, and it always seems to want to take away more. And I'm not telling people don't get into market. I'm really not saying that at all. I'm just saying to look at a lot of different options for you, but first guarantee your income. Think about this. When you're working, would you take a job if you needed to make $25 an hour and that was the bottom line for you? So it's about $50,000 a year. Would you take a job? Would you take that job or a job that paid you $30,000 a year?
You're going to have to stick with the job that pays my bills, Ron.
You really would, wouldn't you? Because you have to live on that income. So use that mentality and think about this. Why would you, so to speak, take a job with your retirement life savings that didn't give you what you needed right now and for the foreseeable future, that had a minimum amount of risk in it? Why would you bet the farm on, well, I'm going to take a job that pays $30,000, but I'm going to get on a bonus program, and if I do really good as a salesperson, I'm going to make a ton of money. In retirement, you can't think that way. You can't bet on something that you have no control over. And we really have no control over the future, nor do we have control over what the market's going to do. But what we do have control over is what kind of an income plan did we build? I have control over how much risk I want to bring into it. And I have a control over how much I'm going to spend every month. So let's control what we can and plan for minimizing the impact of things we can't control. So, you know, take a hard look at risk. There's nothing wonderful about having a 25% return one year if the following year the market goes down like it did this year at one time, 31%. That's just spinning your wheels. That's all it's doing.
Well, again, we are talking with certified financial planner Ron Courser, and if you need help examining your plan to see if you may be reliant on this financial myth and misconception that the market always goes up, if one or two bad years into the future could throw your plan off track or off kilter, wouldn't you want to know and identify that now and potentially address it? Ron Courser can help you spot and identify that. Pick up the phone, give him a call, 616-301-2594. That is 616-301-2594, 616-301-2594. Ron, closely related to that first one, the assumption, the myth that the market always goes up is that we can depend on a reliable rate of return. Number 2 on your list is that the market always averages 10% rate of return. Now, this is kind of splitting hairs here, but there's a difference between dependable and has averaged. And that's, I guess, the important factor in this financial myth.
Yeah, averages are really strange creatures. I defy anybody. Let's say I talked that the last 110 years, the market's averaged 7.1%. How many years, if you think back, if we went back 110 years and looked at each individual year, how many of those years do you think would have averaged 7.1%? Very, very few.
Right.
The market does not do averages. As people, we do averages. The market gives what the market gives. And every year is a brand new day. Every year is a brand new year. And it may be above 7, it may be below 7, it may be above 20. The market doesn't work on averages because the markets are volatile. So when it comes to planning, what we have to plan for is a volatile stock market for the money we're going to put our life savings into the market. We have to plan for volatility. And the only way to plan for volatility is to do a very deep dive, and we can help people with that in choosing the right kind of asset mix that matches their goal. You are created uniquely by God, Peter. Your goals and objectives are a little different from mine when it comes to our personal financial world. So I can't take what I think is appropriate for me and layer it onto you and think, okay, that should be good enough. That's why when we meet with people, we always very clearly say it's an individual issue. I need to understand what you want to accomplish. We're kind of doing retirement your way, not my way. So let's figure out what you're trying to accomplish, and let's figure out the best options for getting you there that give you the best chance for success. So whether we're going to assume the market's going to do something or not do something, the really key is what's the least amount of risk? What's the most rational? If you plan, if right now, everybody listening there, if you're getting close to retirement and you're going to make a plan adjustment that says, I think I'm going to plan on a 10% average rate of return in the market for the next decade. I hope it works for you. The probability of success is pretty low. That over 10 years, the market's going to average 10% compounded. I mean, I can't hardly find a 10-year period where that's happened. But if on the other hand, you say, I understand volatility and I want to create a plan that deals with the volatility that gives you the potential for some kind of a positive rate of return without losing my shirt, that gives me peace of mind, then we can begin to build a plan that gives you retirement your way, so to speak, that gives you the least amount of risk. So the market always going up, average returns, they're kind of all the same. I just tell people, if you've been working on a plan that says, I'm going to count on a 7, 8, or 9, or 10% rate of return on my money, and it's all invested 100% of the market, it's going to be an adventure, and I hope it works. I just, as a fiduciary and as an advisor, I would never create a plan like that. I never would. And frankly, if you pushed me hard enough to say, well, either give me that 10% rate of return or I'm going to leave, I would say, Peter, bless you. I'm not going to be party to that because I just don't think it's rational.
Yeah, at least not on a dependable, reliable, year after year, linear basis. That's just not the way that average rates of return work. And Ron, we've gone through an exercise on previous editions of the program where you sort of worked through some numbers and gave us a scenario with an average 10% rate of return where the individual invested ended up losing money over the same period of time. And that's before even making any withdrawals. And so I think it was a 3-year scenario. The first year is a 60% return. The second year is a negative 50% return. The third year is a 20% return. Up 60 minus 50 is 10, plus 20 is 30, divided by 3 is an average 10% rate of return. But if you take those returns and invest $100,000 and then experience them, at the end of that 3 years, you only have $96,000 left. And so the Dalbar Institute and Morningstar do a lot of studies on why there's this big difference between what the market averages and what the average investor actually experiences in their growth. And one of it is emotion. Two is making mistakes, doing the wrong thing at the wrong time. But the third one is that linear averaging does not actually work with reflection of what actually happens to your money. And so if we're relying on that for retirement, Ron, that's inherently increasing the danger and the risk to our retirement, that we are not going to end up where we've projected.
Yeah, when you deal with averages, you assume almost a straight line kind of thinking, but the markets don't do that. The markets are up, down, sideways, up, down, sideways. That's the nature of the market. There's volatility. That's why it doesn't make sense to say, well, I'm going to bet on an average rate of return, particularly if it's 7 or 8 or 9%, which leads us into the next one. So if this is making some sense to everybody listening to today's program, give us a call at 616-301-2594. We can meet and I can really demonstrate and show you the difference between an average return and a real rate of return in a volatile market. Because when people see that, it's really interesting. It's not that hard to diagram on a whiteboard here in our office. And when people see that, their eyes open up and they say, wow, nobody ever told me that before or showed me that before. So the seeing is believing, but understanding what we're doing makes even greater sense. So if you'd like to see the reality of rates of return and market volatility, give us a call at 616-301-2594. We can help you with that. We can show you that. And what I tell people is most people are very, very capable of making good decisions if they have good information, critical facts. And understanding the difference between an average return and a real rate of return is a critical fact. And when you see that and you grab onto it and it becomes, yes, I understand, it changes the whole concept of how am I going to retire and how am I going to get income from retirement plan.
Well, again, if you have questions about any of those factors of your planning, completing the plan, getting income from that retirement plan, that is exactly what Ron Courser, certified financial planner, can help and assist with. Certainly not the only factors in planning, but a large part of what he does for his clients there at Ron Courser and Associates is figuring out how to make that transition with confidence into and through retirement. If you've got questions or concerns about that process in your own planning, pick up the phone, give a call, 616-301-2594, 616-301-2594. Ron, you do a great job of making it a pressure-free process. There's no cost, there's no commitment, at least for that initial conversation. It is a strategy session. You're getting to know people. They're getting to know you. You're helping point them in the right direction. But at the end of that time, you get a pretty good feel for if there is areas that can be improved upon, strategies that can help them leverage their dollars, opportunities that they should be taking advantage of.
Yeah. And wouldn't it be nice if somebody just wanted a second look, a second set of eyeballs? If somebody like me looked at everything and said, as a fiduciary, I have to do what's in your best interest, and what you've got put together based on what you want to accomplish, you're fine. You don't have to make any changes. It's been a pleasure meeting you. That's a good conversation too. Do we want more people to become clients? Absolutely. But it's also our job to say, if you've done something well, you're going to hear that from us. We don't just start with the idea that everything you've done has to be changed, when a lot of times people have done some pretty good things. So that's a key understanding. So give us a call, for that second set of eyeballs I'll give you this example. I have to have some more surgery because I'm out of warranty on my back. And I did go, even though I know who I'm going to end up using, he's done it before, I still got a second opinion. I still do. It's not that I don't trust the guy that I've been with. He's really good. I just want to make sure I'm covering all the bases, because this is about me. I want to have a successful surgery. People want to have a successful retirement. Having a successful retirement means you have all the critical facts in front of you to make great decisions. And sometimes those critical facts can come from a second or third or fourth party that gives you what you need to make that good decision. So give us a call and we can help you with that.
616-301-2594. That is 616-301-2594. That's all the time that we have for right now, but we will talk to you again real soon, right around the corner here on Your Course to Retirement. And we're back here on Your Course to Retirement, certified financial planner, Grand Rapids resource for a common sense approach to planning for your financial future. Ron Courser is here with us, president, founder of Ron Courser and Associates. And today we are covering 7 financial myths, common mistakes or misconceptions, assumptions in our planning that if we depend on them and they don't end up holding true, could lead us off track financially. So we need to carefully examine these myths and assumptions and misconceptions and make sure that we are comfortable with including any aspect of them in our planning. Ron Courser here as a certified financial planner, helping us pinpoint and identify where we need to review and evaluate that plan. Ron, you've talked about the process of creating retirement income. Another financial, we'll call it rule of thumb, but a theory that has been really utilized as dependable over the last 30 years, but we're finding might need to be revisited is what has been dubbed as the 4% rule. You've talked a lot about creating retirement income, the need for income. I think the question is, how much income can we generate? And this particular myth has to deal with addressing and answering that question, or at least throwing into question the rules that we have been utilizing.
Yeah, the 4% rule is a rule that it's been around since about 1993. It was created by a guy named William Beckman. He took a look at back in the beginning of the 90s, 2 decades of returns, pension plans, insurance companies, things like that. And he came to the conclusion that a 60% stock portfolio with 40% bonds and cash, as long as you didn't take more than 4% out annually out of your life savings, you'd be okay. Now, he based that on a rate of return of almost 9% for stock markets and a little over 6% for bonds. So,
well, Ron, as we talked about, might not be in that environment, or at least not be able to count and depend on that reliably.
The 10% treasury is at about 0.6%, and we haven't had a 9% compounded rate of return over the last 20 years. So they asked him, interesting, about his rule of 3 or 4 years ago at a conference, and he said he would not use it in his own personal life because it's too risky. Now, he's not a dumb guy. What's changed? The world has changed, and financially, stocks have changed. Yes, if you bought, Apple at $5 a share and all those other ones at $10 a share, you're in hog heaven right now. But not many people have done that. So the idea that I can take 4% out is kind of subtly based on that idea that the markets are going to go up 7 to 10% a year. So it's really it's a thin ice kind of experience. So be careful of that idea. That's why when you build an income plan, you build as much predictable guaranteed income into that plan as possible before you start looking to your stock market based investments to supplement what you need. And the other one that comes in to play, and I hear this a lot still, is the idea of, here's the question. 10 years from now, Peter, when you've retired, will what you pay in tax be about the same as you're doing now, less than what you're doing now, or more than what you're doing now?
I am assuming, Ron, that it will be more. The taxes will be higher into the future, at least for my personal situation.
Yeah, and it's a pretty safe assumption because what's going on in the world today, our governments are spending money like drunken sailors. And the argument of whether it's appropriate or not is not a good one for this program at this time. But they're spending more and more money. And the only way the government can back that up is how? They need to extract more money from people who have money. And unfortunately, that's the middle class. It's not the 1% rich guys, the Wall Street people, the athletes and Hollywood people. It's the middle class where the most of the money is. So you might assume, well, I'm going to be making a little less money in retirement because the job I'm making now pays me $150 a year and I don't need that much. I'll kind of listen and go along with that. But here's where the tax issue comes into play. Most people assume that the federal tax that we're going to have to pay somewhere down the road is going to go up. But there's other taxes to consider. There's state taxes, local taxes, real estate taxes, gas tax. There's an enormous number of taxes. So by focusing only on the income tax that we have to pay, sometimes we can kind of fall into that, I'm going to be okay because my IRA is not going to be taxed that much. Your money is going to be taxed, particularly what's going on in this year. Local governments, state governments, they're desperate for revenue. So 10 years from now, it's probably going to be more expensive. So the idea that taxes are going to be lower, that means I'm going to pay less, doesn't make a lot of sense to me. What does make sense is saying, look, you've got 10 years before you retire, 5 years before you retire. Let's figure out a way to take money that's going to be taxed forever out of an IRA, 401k, and move it into an account that's never going to be taxed again. And what might that be? It can be a Roth IRA. It can be cash value life insurance that can work that way. Both of those accounts can create tax-free income that doesn't even show up on your tax return. So that people say, well, it's too late for me, or I can't do it. The answer is no, yes, you can. It's never too early to try to figure out how to take a portion of your money that's going to be taxed forever and move it away in a place where it's not going to be taxed anymore. And that's where a Roth IRA strategy, conversion strategy can happen. Or if you've got a 401k Roth at work, man, put more money into that. Yeah, you're going to pay a little more tax now, but the savings down the road is going to be enormous, just absolutely enormous. So dealing with taxes is an important part of the plan. You know, we always think, well, I need $50,000 a year out of my life savings. Well, if it's in an IRA or 401k, you're going to have to take out perhaps as much as 70 or 75, depending on how the tax situation is, to net that 50. That means you spend your money faster than you anticipated. Not a good idea.
Well, Ron, we're obviously going to need to be conscious of taxation in retirement, especially since the American public, by and large, has saved the majority of their retirement dollars in these tax deferred accounts. That's a yet to be paid bill, kind of an unfunded bill that is out there. It is funded. The money to pay it is right there in our retirement account, but it's going to be deducted from that account every time we need to pay a bill or have an expense or make a withdrawal.
Yeah, it is. And the other part that sometimes, and this is the advantage of doing a really complete planning analysis, is sometimes people need to take so much out of their IRAs and 401ks that they end up increasing the taxation of their Social Security benefit, because that's another calculation to make when you're putting together a retirement plan, is what's the tax implication of what we're trying to do? How does it impact the Social Security benefit that I've put a lot of money into and worked hard to get? And what happens to perhaps some of the other things in my life too? So it's an important concept to talk about. As a firm, we don't take the position of, well, that's a conversation you have to have with your tax advisor. That doesn't make a lot of sense to me as a certified financial planner to just say, well, let's just go invest this and go see your CPA and let him tell you about the taxes. I'm fully capable of doing a back of the envelope calculation. I'm not a CPA. I don't do taxes in our firm, but we're smart enough to figure out how to read a tax return. And we're smart enough how to read a 1099 to determine what kind of taxable income people are going to have. And we can create a strategy to perhaps minimize it, reduce it, or in some cases, even eliminate it. So it's an important conversation that we have. We don't farm it out. I'm not going to give you tax advice. I'm going to give you tax options. And let's pick the best one that makes the most sense to you.
But the more that we can keep of our money, the more efficient that we can be, the less that we pay in taxes. It makes our money last that much longer, and it decreases the amount of stress and strain and reliance we're placing on our portfolio. So again, obviously a very important part of the planning process is figuring out what that tax liability is going to be. Absolutely not to be overlooked, and one of the important financial myths that Ron Courser has identified in this report. And ladies and gentlemen, if you've got questions or concerns, if you want to make sure that your plan is not reliant upon nor exposing you to any of these financial myths, pick up the phone, give Ron Courser and Associates a call. They'd be happy to hear from you. They are happy to sit with you and review your plan to make sure that you have one that you can count on, depend on, that you have identified what assumptions are included in that plan, and that you are comfortable with those assumptions. 616-301-2594, the number to call. That is 616-301-2594. 616-301-2594. Ron, another one I think we could fool ourselves into maybe falling victim to and convince ourselves that it's really not a necessary part of our plan is the need for life insurance. At a certain point in time, we've got the kids raised, they're up and out of the house, we've got the house paid off, we're retiring, we no longer need to replace an income, we've got this amount that we've saved up, this nice lump sum for our retirement, and hey, we got all that checked off. Why do we need life insurance? But really, life insurance can continue to play a pretty valuable role, correct?
Life insurance is another asset in retirement. You know, I guess this is where Dave Ramsey and I digress a little bit. I think properly positioned with a person's retirement planning, life insurance plays a role. I'm not saying everybody should have it or don't have it. I'm just saying to overlook its importance and what it can do in a retirement plan is really short-sighted. What do I mean by that? I've been in this business almost 26 years now. We've experienced quite a few clients over that period of time where the spouse has died. When that happens, I have never had, if they've had life insurance, I've never gone to the widow and said, Mrs. So-and-so, we had life insurance and your husband died and here's a check for $300,000. I've never had anybody say to me, I don't need that, just take it away. Fact is that when one spouse dies, strange things happen. Number one, you lose a Social Security benefit. Number two, you have less income. It means you may have to take more income out of a tax-deferred account because trust me, one person cannot live on 50% of what two persons were living on. There's a lot of fixed costs in life, including things like taxes, cost of food, gas, and stuff that come into play. So why would somebody like me say it's something to look at, just like everything else? Because in certain situations, if we use it properly structured, it can be an incredible asset. Number one, it can provide for the surviving spouse. Absolutely. I have it in my own life. My wife, Nancy, is younger than me. If God calls me home, I get hit by space debris, she's going to be okay. Number two, properly structured life insurance can be a great way to save or to set money aside to create cash flow that's tax-free. Number three, a good properly structured life insurance contract that has cash value to it can be a great source of long-term care to cover those expenses. In Grand Rapids now, in a reasonably decent place, it's 8 or 9, I've had a couple of clients paying $10,000 a month. It would be nice to have that money coming from somewhere other than an IRA. Sure. It really would be.
Sure.
So it's something that has some uses, but it's like a lot of things in life. You know, some people say, oh, you don't need life insurance. I don't believe in life insurance. I tell people I don't believe in it either. It's just like I don't believe in stocks and bonds and mutual funds. I don't believe in annuities. I look at financial products and say, what can it do for you that makes sense? And what's the best approach to cobble all these things together? So life insurance may be appropriate for some people. A lot of people, we've been bred with the idea that it's a waste of money and it's a bad investment. I would tend to agree. I don't look at life insurance as an investment, just like I don't look at my house as an investment. It's just a place where I live. I'm actually paying rent in the terms of the taxes I pay, heating, cooling, and all that stuff. It's just another place where money goes. It's another asset. Yeah, if we sell the house, we'll get some money. but we have to go somewhere else to live. So it's just one of those things. I tell people, don't overlook it just because maybe you had a life insurance guy that beat you up 40 years ago over the kitchen table and you gave him $30 just to get him out of your house. Properly structured, it happened to me when I was young, when I got out of the Army.
That sounded like a little personal story there.
This guy came to my house at 6 o'clock, and at 9 o'clock, I finally threw my hands up and say, okay, I'll give you $30 a month. Sell me some life insurance. Please don't ever come back. This scarred me for life. It really did.
Well, Ron, to me, it's about confidence, though. It is about living that fulfilled lifestyle together, especially that we envision retirement to be about. Because if I am envisioning me and my wife with a certain amount of money on the day that I retire, I want to do all of the things that we envisioned doing and enjoying together with her. But if I'm doing those things and watching my account value go down and down and down throughout years and decades in retirement, I'm pulling back. I'm not doing all of those things. I'm being more conservative, and maybe we are not living as fulfilled a lifetime together as we possibly could. But what would give me that confidence back is knowing that if I predecease her, if I have medical expenses, if we use up all of the money together and then I pass away, that she gets her tank filled back up. She gets a refill, and she gets the ability to have the financial wherewithal to go on living that fulfilled lifestyle even after I'm gone. So it's at that point in time, it's maybe not about replacement of the income because of a dire need on the day that we get that life insurance. Right now, in other words, in my lifetime, I'm young, I've got kids, I've got a mortgage, I've got a job that I need to replace. The reason why I buy life insurance is if I pass away today. But in retirement, the reason why I envision wanting the reassurance and the confidence of life insurance is if I live too long, there is another bucket, another asset, more dollars there for my wife, for my loved ones to continue living the lifestyle that they are comfortable with.
And it also has to do with the simple fact that you may live a long time. Everybody listening to this program has the potential. It's an interesting number, isn't it? A couple 65 today, they got a 25% chance that one of them is going to live to be at least 98. What does that do? That increases the need for income that you can't outlive. And so properly structured, life insurance can be a great source of additional tax-free income. It can also be a great source, again, of what happens if you have a major medical issue go on. So there's a lot of reasons to take a look at it. And like a lot of things, is it right for you? And I tell people, if you don't like it, I get it. But as a fiduciary, it's really necessary for me to behave a little bit like a doctor. I'm not a doctor. I tell people, even though I'm a certified financial planner, a lot of people in my profession say, well, we're just like doctors. I say, no, I don't want that. No, I'm not like a doctor. If I make a mistake, it maybe cost you some money. If a doctor makes a mistake, it could kill you. So I'm not in that program. But what I am is a fiduciary. I have a responsibility to kind of walk with you and explore all the different options. And this is just another option to take a look at.
Well, again, if you'd like the help of a certified financial planner, a CFP, give Ron Courser a call. They make their time available there in the office. They can conduct the meetings virtually through the ease, convenience, the safety of technology. To get that process started, visit online, roncourser.com, roncourser.com, or give a call, 616-301-2594, 616-301-2594, 616-301-2594. And Ron, the thing that you mentioned about the ability for life insurance to help cover the potential for long-term care expenses, even if I maintained my account value, grew my account value over the decades in retirement, there's the possibility of draining assets down very quickly if I do incur some type of care requirement and care expense. And so having that there as an additional asset that I've leveraged, that I can use somebody else's money to help me pay for, or at least offset that need. Again, adding to the financial confidence, adding to the fulfillment, adding to the ability to live life and retirement on my terms.
Yeah. And that's what it's always about, living on your terms with a plan that you like and understand, that will cover a lot of the what ifs in life. Because it's the what ifs that, if we don't plan for, it's the what ifs that turn around and kind of bite us in the hindquarters a little bit. So let's talk about the what ifs. Come on in, call me, 616-301-2581. We can talk about the what ifs and all those things that you were afraid to ask, but here we go. Ron Courser is going to ask you about them so we can talk about them. It's like when you go to get a physical at the doctor, don't you ask them questions about what's going on? I mean, you want to know. I want to know. How's the blood work come out? Tell me what's going on. Am I okay? Do I need to do something? It's the same way in retirement planning. We have to take advantage of those things.
Here's the thing, Ron. I always think of my best questions after I leave the doctor's office. And for some reason, whatever reason, I don't feel like the doctor offers me the sense of that kind of relationship where I can email him or call him and say, hey, I forgot to ask you about this or that. It's like setting up a whole new appointment, going in. It's a whole different thing. But there at Ron Courser and Associates, I know that it's a relationship. It's not just a one-time physical and then good luck to you until next year, be on your way. You offer that as an ongoing relationship. If I think of a few questions after our meeting and strategy session, you're there, your team is there as resources, and you welcome that kind of open dialogue and communication. I think that makes a big difference.
I do. I think questions are important. I laughed about going to the doctors because when I go by myself, I come home and my wife, Nancy, says, well, what did he tell you?
What'd you talk about? Yeah.
Said, I'm okay. He said, well, what about this? I said, I guess I'm okay. We didn't talk about it. You didn't ask him? I said, no, I just asked him if I was okay. He said I was. And it drives her crazy. So I've started going to the doctors with little notepads saying, here's a couple questions because my wife needs to know. So it's the same with us.
Yeah. They ask better questions, more questions than us.
They really
a lot
do.
Of times.
And these are things we need to go through. I always tell people after the first time you come in, I almost guarantee that when you're with your wife or your husband, going home from that first appointment, about 10 minutes after you get away, you're going to say, oh, I didn't ask him that. So that's why we try to be as thorough as possible with everything we do. And we'd love to have you give us a call. I think you'll find the experience coming to our place is as painless and as good as it can be, because what we try to do is answer your questions, give you the information you need to make a really good informed decision so that you're not worried about the what ifs in life. So give us a call, 616-301-2594, and we can deal with the what ifs in life. And the last thing I want to talk about, I get this sometimes. Folks come in and they say, I haven't done the best job planning for my retirement. I don't think there's anything you can do to help me. And I just go, time out. Let's stop right here and not think that way. There's always something you can do. Always something you can do to improve your position. I guarantee that if we go through this whole process that we take people through, there's always something that can be done to better your situation. It's never too early to start, and it certainly is never too late unless you think the doctor says, well, by next Saturday, you're going to meet your maker. That's a whole different situation. But it's never too late. Think about this. We have a retirement crisis in America. Most people don't feel comfortable about where they are planning for retirement. And there's a lot of really good reasons for that. But the best approach is not to just kind of overlook it or don't think about it, maybe it'll go away. The best approach is to say, here's where I am right now. Ron, what do you think? And I'm not going to tell you what I think until I ask you a bunch of questions. But I have never seen a situation where we can't make something even a little bit better. So give us a call. It's never too early. It's never too late. We can make things a little better. I know that because it's been my experience in 26 years. So call us. Whether you think you don't have enough in the market or you have too much in the market, whether your savings enough, whether you have enough income, all those things, give us a call, 616-301-2581, and we can answer those what-if questions. You will leave our office with a much better frame of mind, and you'll have a little more peace of mind. That's one of the things I tell people. That's at least what we can give you after that first time we meet.
616-301-2594. 616-301-2594 is the number to call, or go online, roncourser.com. roncourser.com. Lots of great resources, educational workshops available on demand, radio programs, previous editions of the podcast. You can you can subscribe, you can share. They are listed by specific topic. So if there is a topic that you have interest in, something that you have been thinking about, Social Security, Medicare, Roth conversions, taxation in retirement, how to create retirement income, there's a number of different podcasts, a library from the past years of education available at your fingertips. Go to roncourser.com, subscribe, share. You can listen to the podcast there. You can see calculators, reports, different tools available for your planning. And of course, if you like this report of the 7 financial myths to go over on your own time, that is included as well. Pick up the phone, give a call, 616-301-2594. That is 616-301-2594, 616-301-2594. Ron, we always appreciate your time. You always give us an interesting glimpse of what we need to be doing or thinking about or considering in the financial world, an angle to consider and ponder, and the information that we need in order to make more informed and thoughtful decisions.
Well, Bob Dylan said a long time ago, the times they are changing. So just hold close to that, and we can help you with the changing times. So give us a call. I'd be more than happy to talk with you. Take care.
Certified financial planner, CFP Ron Courser, available for a complimentary review retirement planning strategy session. No cost, no obligation, no downside for placing the call, no benefit from procrastinating. He's looking forward to hearing from you, helping in any way he can in addressing and answering your questions or concerns. 616-301-2594, 616-301-2594, and we'll talk to you next time on Your Course to Retirement.
Tune in to Ron Courser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncourser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.